looking out further after this recession, we do see a lot of positive catalysts, and therefore we would expect that going forward, equity performance will be better than over the last 18 months.
After years of well-performing equity markets, investors are currently facing difficult times due to months of high volatility, high inflation, and bear markets. Today I'm talking to Lars Schickentanz from Anima. Hi Lars, lovely to have you in this call today.
Thank you very much.
So what is your opinion on the current equity markets?
We think we would hope that we have seen the trough for this equity bear market. We're just witnessing a very sharp rally, which may be a little bit overdone. But if we look out for the next 2 years, we do see a number of positive catalysts on the horizon, which definitely the fall in inflation, the pivoting, then the cut in US rates, a potential end to the Russian-Ukraine war, followed by a trillion euro dollar rebuild program, China reopening. So looking out further after this recession, we do see a lot of positive catalysts, and therefore we would expect that going forward, equity performance will be better than over the last 18 months.
So given a positive outlook for the future, is there any countries and sectors that are to be favored currently?
So based on our macro conviction view, that basically two key themes that we will witness over the next 12 months is China reopening, full-blown reopening, and second, first the pivoting, and then the cut in US rates. All of this points basically to stronger emerging market outperformance and a weaker dollar. So from an asset allocation perspective, I would argue that emerging market is the place to be, or if you play it within a European portfolio, of course, sectors style that tilt towards emerging markets. And those two key factors I was highlighting earlier.
As you've said, there's a positive outlook for equity markets at the moment, but we still have very uncertain times. So do investors need to increase their short book?
Shorting is, of course, a very delicate affair. I think as a general rule of thumb, you can amount increasing short positions when volatility is low and when you have a turning point ahead of you. Generally speaking, in times of very high uncertainty, we don't favor high positions, because high uncertainty means it can go either way, and therefore it's unwise to run high short positions. However, as the market doesn't move in a straight line and in various phases, I think maybe in December for the early part of next year, it's wise to mount back or to increase back short positions, mostly maybe in the cyclical areas where right now there is a lot of call it wrong perceptions on the speed of recovery or the depth of recession.
Another topic which is heavily discussed is value versus growth. And we've seen a high underperformance of value over the past years, but in the current months, it's been under the spotlight. In the current context of the environment, is value investment style to be favored?
This is a very complicated question, and I think it depends on the time horizon. I prefer definitely over this decade a value approach, different to the last 20 years, because I think inflation will be higher going forward than before. And therefore, you lose the key competitive edge while growth has outperformed value. However, if you just look over the next couple of months, where from a macro perspective, inflation will fall and growth will fall, this would not favor necessarily value. So therefore, I would run a more balanced approach. And if you look slightly further out, although longer term negative on growth, when Fed pivots and interest rates fall, this tactically would also favor growth. So long story short, I think it's wise to run a balanced approach.
Last but not least, you run an absolute return strategy. How important is it to ensure stability and performance in your investment philosophy?
Well, this is absolutely critical because our investors expect from us exactly that. So how do we ensure this? Or we try to ensure this is by being factor agnostic. So we try to develop our roadmap, check this on a day-to-day basis, and we have no style bias, no factor bias, no nothing. We're completely agnostic. We just look what all the macro components, ingredients that we put into our thought process, and then look what is the output. Where do we want to go? Where do we want to tilt our portfolio in? We're a very active fund manager, and therefore we can react also to short-term different views, and we can change our views also if the macro requires that. So the process is vital.
Therefore, Lars is seeing a positive outlook for the equity markets, but is running a very balanced portfolio. Thank you very much for your insights, Lars.
Thank you very much.